$35 per ounce. For 27 years, that price never moved. Any nation on earth could walk into the US Treasury with dollars and exchange them for gold at that rate. The promise was explicit. The promise was absolute. August 15th, 1971, Sunday night. That promise disappeared. Someone canceled it unilaterally. No warning, no notice to allies, no negotiation, no agreement, no procedure. And within less than a decade, gold hit $850 an ounce in January 1980. 2,300%. Look at that number. If you held 1 ounce of gold in 1971, by 1980 that asset had multiplied 24 times. On the other side, if you held only dollars in 1971, your real purchasing power was being sliced away, piece by piece. Inflation crossed 11% in 1974. By 1980, it broke through 13%. This was not a simple exchange rate adjustment. The foundation of the international monetary system had shifted, and in the process, wealth moved. The question then is this: who lost first? And who was structurally positioned to gain? To see the answer, we have to go back to the moment the anchor was first dropped. 1944. Bretton Woods, New Hampshire. That summer, as World War II was drawing to a close, delegates from 44 nations gathered at a single hotel. One agenda item: how to run the world economy after the war. No one wanted to repeat the failures of the 1930s. During the Great Depression, nations had competitively devalued their currencies. They erected trade barriers, world trade collapsed, and the economic wreckage helped ignite another war. A new architecture was needed to prevent that failure from recurring. The conclusion reached by 44 nations was simple: drop an anchor of gold into the ship called the dollar. The core structure worked like this: fix the US dollar at $35 per ounce of gold. Tie every other nation's currency to that dollar. Global exchange rates would stabilize. Trade would become predictable. Speculative currency wars would be prevented. To honor that commitment, the United States explicitly declared it would exchange dollars for gold at any time a foreign central bank presented them. The world economy began to move on top of this anchor. The Bretton Woods system was born. The first 20 years worked. Europe and Japan rebuilt from the ashes of war. The United States pumped dollars into the world through the Marshall Plan. Global trade expanded. Growth continued. The dollar became an asset as trustworthy as gold itself. In the late 1940s, U.S. gold reserves hit a historic peak, roughly $24.7 billion worth of gold sitting in American vaults. The United States held a dominant share of the world's monetary gold. This concentration of power made Bretton Woods possible, but buried inside this elegant system was a crack, present from the very beginning. In the early 1960s, economist Robert Triffin identified the system's fatal contradiction. For the world economy to grow, it needed more dollars. To supply those dollars, the United States had to keep running trade deficits. But as deficits accumulated, confidence in the dollar eroded. More liquidity meant less credibility. Preserving credibility meant insufficient liquidity. This was called the Triffin dilemma, and through the 1960s, that dilemma became reality. In the 1960s, the United States did two things simultaneously. It fought a war in Vietnam, and at home, the Johnson administration expanded welfare programs aggressively: guns and butter. These two streams of spending demanded massive dollar issuance. The United States printed dollars. Those printed dollars flowed out across the world. The problem was simple arithmetic. The volume of dollars circulating worldwide kept growing, but the gold sitting in American vaults was shrinking. U.S. gold reserves, roughly $24.7 billion in 1949, were already overtaken by total overseas dollar holdings by 1961. By 1971, American gold had dropped to around $10 billion, while foreign central banks held nearly $40 billion in dollar claims. Mathematically, the system was already insolvent. The moment foreign central banks demanded gold simultaneously, the American vault would be empty. Cracks were forming in the anchor line. The ship had grown too large. The anchor had not. The first to grab that crack, the most brazenly, was France. February 1965, Paris. President Charles de Gaulle stood before a press conference, quietly, but with unmistakable resolve. The United States prints dollars to pay its debts. The rest of the world must accept those dollars as though they held real value. A privilege, an exorbitant privilege, enjoyed by America alone. The phrase, exorbitant privilege, had first been coined by the French finance minister. What de Gaulle saw was this. European central banks were piling up dollars. Those dollars were the equivalent of interest-free loans to the US government. With that funding, America was fighting in Vietnam and buying up European companies with dollars. France believed its own money was being used to fund policies it never agreed to. De Gaulle pulled out economics as a weapon. France began shipping its dollars back to the United States and demanding gold in exchange. That was the right Bretton Woods had guaranteed. Spring 1971. The cracks began to rupture. In early May, $1 billion in speculative capital flooded into West Germany in just 2 days. Money anticipating a dollar collapse was buying Deutschmarks. The Bundesbank shut down currency markets. Austria, Belgium, the Netherlands, and Switzerland followed. All of Europe was absorbing dollars it did not want. Then, in August of that year, the defining event arrived. A British government representative came to the US Treasury. The request was simple. Exchange $3 billion worth of gold. Diplomatically, it was a polite inquiry, but the mathematics beneath it were catastrophic. $3 billion. That was more than a quarter of the $10 billion in gold the United States still held. In physical terms, over 2,500 metric tons. Honor Britain's request, and France would be next. Then Germany, Italy, Japan. American gold reserves would be bare in an instant. At the time, total dollar claims outstanding were 4 times the gold on hand. 1/8 the gold needed to cover $40 billion in claims. Treasury Secretary John Connally was in a state of panic. He saw this as a de facto bank run on U.S. gold reserves. Friday, August 13, 1971. Nixon secretly summoned his top economic advisors. The location? Camp David, the presidential retreat in Maryland, outside Washington. The State Department was not invited. Allied nations were not notified. The IMF was not informed. Paul Volcker, Undersecretary of the Treasury, later recalled that the IMF director had been told only hours before the announcement. Treasury Secretary Connally, Undersecretary Volcker, Fed Chairman Arthur Burns, Budget Director George Shultz. These men argued through the entire weekend. Fed Chairman Burns was fiercely opposed. He later wrote in his diary, "We are unleashing forces that should not be unleashed." Paul Volcker had brought a thick briefing book outlining a gradual transition to minimize the shock. He later said in his memoirs, "Most of what we prepared was ignored." Nixon chose Connally's hardline approach. Nixon's overriding concern was one thing. This decision must not be seen by the public as a defeat. Sunday, August 15, 1971, 9 o'clock in the evening. On any other night, the popular drama Bonanza would have been on. That night, instead of the show, Nixon appeared. He declared, "I am directing the Secretary of the Treasury to suspend temporarily the convertibility of the dollar into gold." Temporarily. The viewers watching that broadcast had no way of knowing that temporarily would become permanent. Nixon framed the decision heroically, a bold stand to protect American workers from foreign speculators. Domestic reaction was euphoric. The New York Times applauded the president's boldness. The Dow Jones recorded its largest single-day gain in history the following day. But across the Atlantic, the reaction was something else entirely. What disappeared in that moment? A promise disappeared. A promise that had served as the anchor of the financial system for 27 years. The promise to exchange dollars for gold at $35 per ounce. Every nation that had accumulated dollars on the basis of that promise. every central bank that had held dollars as its reserve currency trusting that promise. The exchange value of every dollar they held was extinguished in an instant by a unilateral American decision. The anchor line was not severed, it was cut by the captain standing on the deck. From this moment, the nature of the dollar system changed. The dollar was no longer a certificate backed by gold. It became a credit currency issued and managed by the United States government itself. August 15, 1971. The U.S. government canceled a 27-year-old promise. What was obliterated by that decision? The full amount of America's gold exchange obligations to every dollar-holding nation on Earth. Foreign central banks were sitting on $40 billion in claims. Those claims became unenforceable paper overnight. Put differently, the United States closed out its gold-denominated foreign obligations and dispersed that cost across the entire world in the form of a dollar revaluation. This was not a negotiation. This was not a transaction where buyer and seller sat at a table and agreed on a price. This was, in effect, a unilateral withdrawal from an obligation, and no nation was given the opportunity to consent. Monday morning, August 16th. Currency markets in London, Paris, and Frankfurt opened, but no one could price the dollar. According to the Bank for International Settlements 1972 annual report, major European foreign exchange markets were effectively open but paralyzed. What benchmark do you use to set an exchange rate? If the dollar is not backed by gold, what is the dollar? The entire world stopped in front of that question. In Tokyo, the Bank of Japan tried to hold the exchange rate at 360 yen. On August 16th and 17th alone, the Bank of Japan purchased $1.3 billion. Within 2 weeks of Nixon's shock, Japan's foreign reserves had swelled by more than 30%. To defend against the falling dollar, they had to print enormous quantities of yen. At the time, Japan depended on the U.S. market for 31% of its total exports. The 10% import surcharge Nixon announced alongside the gold suspension was effectively a direct strike at Japan. Connally demanded a 17% yen revaluation from Japan's finance minister. Japan fought back and held the line at 16.9%. The entire world was absorbing the shrapnel from Nixon's Sunday night broadcast with its own body. Inside that chaos, on one side, money was quietly moving. Gold holders. The price that had been locked at $35 was now free to rise. Gold was no longer capped at $35 by an artificial ceiling. The market began translating dollar anxiety and inflation expectations directly into gold prices. Gold, which had been $44 in 1971, crossed $106 within 2 years. As the dollar wavered, gold absorbed the dollar's anxiety into its price. Then in 1973, another shock arrived on top of the first. The Middle East war triggered an OPEC oil embargo. Oil, which had been $3 per barrel, quadrupled. Gold kept climbing. $184 in 1974, $306 in 1979, and in January 1980, an intraday peak of $850. If you had held gold in 1971, 9 years later that asset had multiplied 24 times. This was the first transfer route, from dollar holders to hard asset holders. But that was not the whole story. A far larger transfer was being prepared, and it would begin in the desert. In October 1973, war erupted in the Middle East. OPEC banned oil exports to the United States and its supporters of Israel. Energy supply chains seized up. Factories cut production. Lines formed at gas stations. In winter, rolling blackouts swept across Europe. The Nixon administration sent Henry Kissinger to Saudi Arabia inside that crisis. The objective was singular: build a new anchor for a dollar that had lost its gold backing. The reason dollar demand could survive even without gold was straightforward. If the settlement currency for oil, the essential commodity of the modern economy, were fixed to the dollar, the world would need dollars indefinitely. 1974. Riyadh. The negotiation came down to two terms. Saudi Arabia would denominate all oil transactions exclusively in dollars. The United States would guarantee the security of the Saudi royal family and supply advanced weaponry. There was no published treaty, no official signatures. The substance of this arrangement did not become fully known to the world for decades, but its effects were immediate and permanent. This was the new anchor erected in the place gold had vacated: oil. Every nation on Earth needs energy. To sustain modern civilization, you need oil. To buy oil, you need dollars. To get dollars, you must trade with the United States. The role that gold had assigned to the dollar at Bretton Woods in 1944 was inherited by oil at Riyadh in 1974. The petrodollar system stood on three pillars. First, payment monopoly. Oil could only be purchased in dollars. Second, capital recycling. Saudi oil surplus dollars were reinvested into U.S. Treasury markets. Third, security guarantee. The United States provided military protection for the Saudi royal family. These three structures combined, and the dollar was re-anchored, not merely as America's currency, but as the central currency of energy trade and global capital circulation. Other major OPEC oil-producing nations subsequently joined this dollar settlement structure. The drifting ship appeared to be adrift, but the captain had found a way to command the sea itself. Oil, the new anchor. The petrodollar system began to operate. But this story must not be read as a master plan brilliantly engineered by the U.S. government. The reality was different. Go back to Camp David. Nixon said he was suspending dollar-gold convertibility temporarily. He was not trying to dismantle the Bretton Woods system. He was simply trying to stop the immediate crisis. Listen to Volcker's recollection again. Most of what we prepared was ignored. What Volcker wanted was a gradual transition to minimize the shock. What Connolly wanted was a pressure card against the Allies. What Nixon wanted was his approval ratings ahead of an election. The 1974 petrodollar arrangement was also not a pre-designed dollar hegemony 2.0. It was damage control, finding a new prop for a dollar that had lost its gold backing. The structure only looked like strategy. Crisis created opportunity, and the opportunity was seized. So who bore the cost of the crisis? What price did the United States pay? After the Nixon shock, as the dollar's link to gold was severed, the Federal Reserve lost its last external discipline. Dollars could now be printed without limit. Where the constraint on monetary expansion had previously been gold outflows, it now became the slower and far more political forces of market confidence and inflation. That consequence gnawed at the U.S. economy throughout the entire 1970s. According to U.S. Bureau of Labor Statistics data, consumer price inflation exceeded 11% in 1974, 11.3% in 1979, 13.5% in 1980. Inflation was outrunning bank interest rates. Money sitting in a checking account was melting away, untouched. Mortgage rates made it nearly impossible to buy a home. High inflation and high unemployment arrived simultaneously. An economy stuck with both recession and inflation at once was a phenomenon the economics textbooks had not anticipated. A new word was coined: stagflation. The Nixon and Ford administrations introduced wage controls. They even ran a campaign distributing buttons that read, "Whip inflation now." All of it failed. The winner of the Nixon shock was the U.S. government. It had obliterated $40 billion in gold exchange obligations in a single instant. But what price had that winner paid? A decade of stagflation. The man who ended stagflation was one person: Paul Volcker. In 1979, Volcker took office as Fed chairman and administered a brutal remedy. He raised interest rates. He kept raising them. By 1981, the benchmark rate had exceeded 20%. No one could buy a home. Businesses could not borrow. From 1981 to 1982, the United States suffered its worst recession since the Great Depression. Unemployment climbed to nearly 11%. Congress erupted in criticism. Business leaders sent letters of protest. Volcker did not stop. By late 1982, inflation had been broken below 5%. The cost was enormous. But without the gold anchor, a new anchor for the dollar had been built. The intangible collateral of central bank credibility filled that space. In the end, what sustained the dollar system was not gold. It was the belief that the central bank would defend the currency's value, even at the cost of recession. Then who lost the most? There were invisible losers, fixed income savers worldwide. In the 10 years after 1971, real purchasing power evaporated by more than 30% due to rising prices. People who kept their dollars in the bank. People who lived on fixed interest while preparing for retirement. Their assets were quietly melting away. Developing nations. The real value of their dollar-denominated assets had vanished. What came after was worse. In the era of floating exchange rates, dollar-denominated borrowing exploded. Initially, real interest rates looked low. But when Volcker drove rates to 20%, the debt burden of these nations erupted. Mexico's debt moratorium in 1982 was the opening signal. The debt crisis spread to Latin America, Africa, and Asia. The decision of 1971 was not an ending. It was a beginning. Floating exchange rates, expanded dollar liquidity, and the Volcker shock followed, and the bill arrived in multiple countries a decade later. And Japan. Under the Smithsonian Agreement, the yen was forcibly revalued by 16.9%. The exchange rate, that had been 360 yen to the dollar in 1971, would surge all the way to the 80 yen range by 1995. To maintain export competitiveness, Japan held ultra-low interest rates. Those ultra-low rates created the asset bubble of the late 1980s. When the bubble burst, the lost decades began. Nixon's decision on that Sunday night in 1971 sent a bill to the entire world. The only difference was the delivery date. Half a century has passed. The dollar is still the world's reserve currency, but that status is quietly shifting. According to official reserve composition data published by the International Monetary Fund, the dollar's share of global reserve currencies has fallen from 72% in 2001 to 56.3% as of the second quarter of 2025. Among the flows filling that gap, one is gold, and that current is becoming unmistakable. According to a World Gold Council survey in 2025, 76% of the central banks surveyed expected gold's share to increase within 5 years. 73% said the dollar's share would continue to shrink. In 2022, financial sanctions were imposed on Russia. The United States deployed the dollar payment network as a weapon. Since then, central banks worldwide have accelerated gold purchases, an asset no country can control, no country can freeze. The move back toward physical gold has begun. What Nixon expelled in 1971, the world is seeking again. Now let us look back. In 1944, 44 nations dropped anchor into the dollar. The world economy did not drift because of that anchor. In 1971, the anchor line was cut. The promise was canceled. Those aboard the ship began to drift. In 1974, a new anchor was lowered. Oil. The seas were dominated by the dollar once more. In 2025, even that oil anchor has begun to quietly tremble. More ships are searching for a different anchor, and one question remains. An anchor provides stability. But if the one who holds the anchor also holds the right to cut it, whose stability is it really? A promise is a promise only as long as it is kept. When the structure that underpins a promise begins to crack, the promise can be canceled with a single Sunday night television address. And the bill for that cancellation does not arrive first at the one who broke the promise. It arrives first at the one who believed it. Let us ask one final question. We call the story of 1971 history, but is it really? Even today, the world floats on someone's promise. Even as numbers reassure us, the promises beneath those numbers can change at any moment. The question is not whether a promise can be broken. The question is, who has the power to break it? And when that day comes again, will we be standing on the side that sets the terms of the promise, or on the side that absorbs the cost?